The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Hey guys, today I'll be sharing with you my stock picking system, designed to tune out bad businesses and focus only on promising ones. I'll make it available down in the description so you can use it yourself and maybe get familiar with it while I'm explaining how I use it. I will also cover topics such as how to read annual reports efficiently and in an enjoyable way, because as we all know, reading annual reports is a big part of being an informed and intelligent investor, and sometimes for us beginners it might be a bit complicated and overwhelming. So I'll try to cover that, and also some valuation principles that I've learned along the way. So I hope you guys enjoy this. The structure of my process is not created out of thin air, but is based on fundamental value investing principles laid out by Warren Buffett, Charlie Munger, Ben Graham and Mohnish Pabrai, four of the greatest investors of all time. I've personally been learning how to apply these principles, and I would love to share what I learned with you so far. Let's get started. The businesses I invest in have to go through a series of tests. These are two checklists and my valuation. The goal is to dismiss the idea as fast as possible. If the company doesn't go through checklist number one, you shouldn't waste more time on it. And this is a principle that Mohnish Pabrai preaches and applies. It is inspired in a scientific method.
Because the first thing I'm trying to do is, anytime I'm looking at a business, I'm looking for a reason to stop looking and take a pass.
So first and foremost, you have to know if the company is within your circle of competence.
Ted Williams wrote a book called The Science of Hitting, and in it he had a picture of himself at bat and the strike zone broken into, I think, 77 squares. And he said if he waited for the pitch that was really in his sweet spot, he would bat 400, and if he had to swing at something on the lower corner, he would probably bat 235. And in investing, I'm in a no-called strike business, which is the best business you can be in. I can look at 1,000 different companies, and I don't have to be right on every one of them, or even 50 of them. So I can pick the ball I want to hit. And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, "Swing, you bum," ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle. Defining what your game is, where you're going to have an edge, is enormously important.
But why does this matter so much? So staying within your circle of competence is crucial for successful investing. By investing in businesses you truly understand, you are more likely to make a well-informed decision and avoid costly mistakes. This approach allows you to assess the risks and estimate with a greater degree of conviction the growth prospects of a company, leading to more confident investment choices. So to apply this principle, you first must determine your circle of competence. So start by honestly assessing your knowledge and expertise in various industries, sectors, or business models based on your education, work experience, and personal interests. As a beginner in the investing journey, consider Peter Lynch's strategy and advice for retail investors. He suggests that it's essential to avoid being attracted to things you can't fully understand. Instead, focus on investing in companies whose products or services you use daily. This approach can align better with your circle of competence, especially if you lack significant professional experience. Remember, as a novice investor, you have room to expand your circle of competence gradually. However, remain accountable and humble throughout the process. Don't expect to master complex businesses like Berkshire Hathaway just by reading a single book such as The Intelligent Investor, for example. Take it step by step at your own pace with consistent learning and growth. So with this being said, in conclusion, identify core competencies. So look for areas where you have a competitive advantage or unique insights. This could be industries related to your profession, hobbies, or areas of significant research. And avoid overreaching. Be aware of your limitations and avoid venturing into areas where you lack sufficient knowledge. And as the saying goes, it's better to be approximately right than precisely wrong. So first, when a business comes to your radar, it's a good idea to check out who are the shareholders of that business. For example, the Value Investors Club is an exclusive online investment community where experienced investors share their investment thesis and ideas. Members often present in-depth analysis of companies they find promising and undervalued. Assessing this platform can be highly valuable for investors as it provides a curated pool of investment insights and research from seasoned professionals. Monish Pabrai, a successful value investor and author, is known for his cloning approach. Pabrai openly admits that he models his investment decisions on those made by other successful investors, including Warren Buffett and Charlie Munger. He studies their investment thesis and principles, seeking to replicate their successful strategies in his own portfolio. So basically, if a company is owned by a super investor that you admire and uses a similar strategy to yours, maybe it's a good idea to go further in your research. But why is this strategy so beneficial? Well, first of all, you'll be learning from the best. Cloning allows investors to learn from proven and seasoned experts in the field. By studying successful investors' approaches, one can gain valuable insights into the thought processes, analytical techniques, and risk management strategies of the best in the business. Not to speak about how it saves you a ton of time and makes your process much more efficient. Cloning can save time for individual investors by leveraging the research and analysis of renowned investors. It provides a starting point for further due diligence and can expedite the investment decision-making process. Building conviction is also one of the key benefits of cloning. Following the footsteps of successful investors can help less experienced investors build confidence in their decisions. When you know that a proven investor has analyzed and invested in a particular company, it lends credibility to the investment thesis. But there are also some limitations of cloning. While cloning can be beneficial, it's essential to acknowledge its limitations. Remember that super investors usually run big funds, and even Warren Buffett says that if he was running small sums of capital, he would be investing in completely different businesses. It also delays your information. By the time information about a successful investor's latest move becomes public, the opportunity may have already changed or diminished. Cloning may lead to chasing past returns rather than identifying new opportunities. And at the end of the day, popular investment ideas may attract a significant number of followers, leading to overcrowded trades and reduced potential returns. In conclusion, knowing the shareholders and seeking different perspectives through platforms like Value Investors Club can be instrumental in making informed investment decisions. Additionally, adopting a cloning approach, as demonstrated by Monish Pabrai, can offer valuable learning experiences but should be balanced with personalized analysis and careful consideration of individual investment objectives. Now let's discuss consistency. The first thing you should be looking for is consistency, since this makes your life easy and tilts the playing field when it comes to estimating the future growth or probabilistic outlook of a given business. So first, you should be looking for consistent growing earnings, low debt, R&D, and CapEx and profitability. Then your focus should go to the income statement. Again, looking for consistent net income growth, gross margins of 40% plus, because this indicates the scalability of a given business, then we want to see them capitalize on those margins with net margins of 20% plus. SG&A, or selling, general and administrative costs, as a percentage of gross profit should be less than 30%. Interest expenses should be less than 50% of operating income, and just by doing this, you should be able to keep 80% of the businesses out there out of your radar. Going into the balance sheet, look for steady growth in retained earnings if they are positive. Compare ROE and RONTA, return on net tangible assets, with competitors to see how efficient the management is at deploying their capital. You should also be checking for businesses with little long-term debt. Look for healthy cash and cash equivalents, and also analyze the historical trend in inventories and net receivables. This should do a good job at painting a picture of the key figures in the balance sheet. Now I will break down the points of the cash flow statement that I look at the most, explaining the significance and what the numbers can indicate. So in the cash flow statement, it's fairly simple. CapEx as a percentage of net earnings should be lower than 25% over time, and this would be awesome. But under 50% is also okay. Looking at the historical figures of the numbers of shares outstanding, looking ideally for a decrease, and calculating the augmented payout ratio is advisable as a mean of comparing it with competitors and get a perspective of how much value is returned in cash or buybacks to shareholders. Are you still here? Then you really have an interesting idea. Most of the businesses out there don't make it this far. So now it's time to get serious about this. I will show you exactly how I go through and read annual reports, because as a long-term investor, as someone who is analyzing the fundamentals of a business, a big part of it is to read annual reports. Not just one report, but many annual reports over different years for a particular company. I also read the annual reports of competing businesses in the same industry. So, I want to break down how I go through this. Do I just read an annual report from page 1 to 180, or however many pages it has? Or are there certain sections that I focus more on and some sections that I don't really look at too much? That is what we are going to go through in this chapter. So, to make this video a little more valuable and easy to understand, we're actually going to head over to my computer and I'm going to walk you through a real-life example of an annual report and talk about each of the sections while I'm showing it to you on the screen. So the company that I'm going to be using as an example in this video is Unit Corporation. There's no particular reason why I've chosen Unit, except for the fact that I've recently read this report so that it will make my life easier in explaining it to you guys. For those who don't know, Unit Corporation, ticker symbol UNTC, is an American energy company that explores and produces oil and natural gas, providing contract drilling services and deals with natural gas processing and transportation. Alright, just before we get into the actual annual report, for those who are unaware, this is how you go out and find the annual reports for any company that you are looking for. The first thing you want to do is head over and search the company name along with investor relationships. Then you will see that there is an investor relation page for the public company that you are looking at. So let's head into the investor relation page of Unit Corporation in this particular example. You can see here via the drop-down menu, we can see there's annual reports here. Sometimes the company won't have an annual report page, so they might just have the SEC filing page, particularly if they are a US company. So there are a lot of different sections in annual reports, but I'm just going to show you the ones that are most important to focus on. And I'm going to talk about what I'm looking for in each, as well as how much time I spend looking at each of these sections. So the first section you will notice once you scroll down out of the table of contents is called Business. This is almost always item number 1. It will be the first thing in the annual report. Basically, this section includes all the information about how the business makes money, what it spends money on, maybe its marketing strategies, where it sources its material from, the distribution processes, and any major competitors that it might have. It's basically all the information about a particular business. I highly recommend that you read this at least once for the latest report, because this is what will give you a deep understanding of how the business works and also tell you if it's within your circle of competence or not. Then, one of the most critical sections to pay attention to is risk factors section. This section is designed to provide stakeholders, investors, and interested parties with crucial information about potential risks and uncertainties that could affect the company's performance and financial health. It is essential to read this section thoroughly to make informed decisions and assess the company's risk profile effectively. Let's explore why this section is significant and how to approach it. So this section outlines various internal and external factors that may impact the company's operation, financial condition, and future prospects. These factors can include economic conditions, industry-specific challenges, regulatory challenges, technological advancements, competition, and more. By reading this section, investors can gain insights into the potential hurdles the company may face in the short term and long term. Apart from identifying risks, the section often includes information about how the company plans to mitigate or manage these risks. Understanding the risk management strategies allows investors to evaluate the company's preparedness and its ability to handle adverse situations effectively. This can give confidence to shareholders and other stakeholders about the company's resilience. It's also worth noting that a company that provides a comprehensive and candid risk factors section demonstrates transparency and accountability to its shareholders. It shows that the company is willing to disclose potential vulnerabilities and is committed to keeping stakeholders informed. For long-term investors like us, understanding the risks allows us to make more informed decisions about holding onto our investments or divesting. It can also help us anticipate and ride out market fluctuations with a more steady perspective. I also have some general tips about reading annual reports. If you can, you should use Google Drive because it enables you to put comments and take notes. Jot down important points as you read through the section. This will help you remember critical details when making investment decisions or discussing the report with others. Also, cross-reference with previous reports. If you have access to previous annual reports, compare the risk factors mentioned in the current report with those from previous years. So this can give you insights into how the company's risk profile has evolved over time. And also consider industry context. Understand that certain risks might be specific to the company's industry. Familiarize yourself with the industry's broader trends and challenges to better assess the relevance and potential impact of the risks mentioned. Management discussion and analysis of financial data, MD&A, is possibly the most important part of a report. In this section, the company's management provides a narrative analysis of the financial results and performance of the business over the reporting period. It offers valuable insights into the company's financial health, operating strategies, and future prospects. When reading the MD&A section, investors and stakeholders should focus on specific key performance indicators, KPIs, and check for consistency in the information presented. Here's how to approach this section. So, as I said already, your main priority should be identifying key specific KPIs and KBIs, so key performance indicators and key business indicators. Usually that management provides some hints on what they regard as most valuable to measure their performance over time. Also check for consistency. Compare the current MD&A with those from previous years to identify trends and changes in the company's performances and strategies. For example, a big red flag is if management consistently changes its strategy. Look also for consistency in the language used throughout the report. Inconsistencies or sudden changes in wording may raise red flags or indicate potential issues. Ensure that the information provided in the MD&A aligns with the data presented in the financial statements. Discrepancies between the two could be a cause of concern. Management also often provides insights into the company's future plans and strategy. Understand their vision for the business and evaluate whether it aligns with your investment objectives. Keeping in mind this is kind of a sales pitch because they know investors will read this, so developing a sense of skepticism is useful in reading this section. Similar to the risk factors section, check if the risks mentioned in the MD&A correspond with those outlined in the annual report. This ensures consistency and transparency in risk reporting. Then consider also external factors. Understand the company's position within the broader industry context. Analyze how external factors such as market trends and competition may have influenced the company's performance. Be aware that our investment strategy doesn't depend on macroeconomic factors and external factors, such as interest rates and so on. So you shouldn't lose too much time on these matters. In conclusion, the MD&A section provides a narrative analysis of the company's financial performance and offers valuable context to understand its overall health and prospects. By identifying key specific KPIs and KBIs and checking for consistency in the information presented, investors and stakeholders can make more informed decisions and gain a deeper understanding on the company's financial position and strategic direction. Reading at least 10 years of this section is almost mandatory if you want to make an informed decision. So we've already covered some of the things you should look in the financial statements, but examining the financial statements in detail means carefully reviewing the company's financial reports, including the income statement, balance sheet, and cash flow statement. It involves analyzing the numbers, trends, and relationships between different financial figures. By doing this, you can gain a comprehensive understanding of the company's financial performance, profitability, liquidity, and overall health. Paying attention to the details helps you make well-informed decisions about investing, assessing risks, and evaluating the company's financial strengths. So, take the time to delve into the financial statements and get a clear picture of the company's financial position. Footnotes in a company's financial statements contain valuable information, especially when it comes to understanding their debt situation. By carefully reading the footnotes, you can find comprehensive description of the company's debt. This includes details about the types of debts they have, their maturity dates, interest rates, and any special terms or conditions. It's like getting the fine print on their borrowing, which helps you assess the risk and impact of their debts on their financial health. So don't overlook the footnotes as they provide crucial insights into the company's debt profile. Another quick note on this is that reading reports from competitors is also mandatory if you want to gain a deeper understanding and have a better judgment on a given company. as it helps you understand the industry better, learn from their successes and mistakes, and benchmark and compare the performance of the businesses. After this, you want to make a little exercise of asking yourself whether the management is telling you what you want to know if you own 100% of the business, and also check if the bad news are told right away. So I would also like to go through some red flags that you should be aware when reading annual reports. So if a company shifts its communication or changes its future outlook significantly, it might be hiding underlying problems or uncertainties. So changes in the company's message are a red flag. The disclosure of new risks in annual reports can indicate emerging challenges that may impact the company's performance. So introduction of new risk factors is a red flag. Altering accounting methods can obscure the true financial picture, making it essential to understand the reasons behind any changes. So changes in accounting practices are a red flag. Drastic fluctuations in reserves could indicate hidden financial issues or manipulation of financial statements. So significant changes in reserves are a red flag. Companies may provide adjusted earning figures, which can be misleading. Always scrutinize the reasons for adjustments to get a clearer view on the company's true profitability. So adjusted earnings may be a red flag. Unusual or aggressive tax rate assumptions can affect the company's tax liabilities and consequently its net income. So tax rate assumptions might be a red flag. Reviewing the company's property, plant and equipment (PPE) and its financing can uncover potential overvalued assets or unsustainable debt levels. So checking PPE and how it's financed, it's a good way to spot red flags. Frequent changes in auditors may raise concerns about the company's financial reporting or internal controls. So change in auditors may be a red flag too. By keeping an eye out for these red flags, you can better assess the company's financial health and identify potential risks before making investment or business decisions. Now, I will discuss a taboo topic of when to sell a business. As Monish Pabrai says, there's only one reason investors buy a company, which is to make money. But there are several reasons they sell, and we want to make sure we sell for the right reason, because ideally you'd want to hold forever. So from the insights and teachings of the best investors, I've learned that there are 4 good reasons for selling a business. If the stock's growth expectations and valuations don't make sense, with no margin of safety, consider selling. Using a reverse discounted cash flow model on this one might be useful to understand the implied growth rate in a given business. So when you use a discounted cash flow model, you put an input which is the growth rate you expect the company to grow at for each year. The reverse discounted cash flow model gives you an estimation of the implied growth rate of a given stock at a given moment. So the second reason to sell is if management shows lack of integrity or shows big corporate governance issues. The third reason is if you spot large misallocations of capital. This may warrant selling. So evaluate the magnitude of capital allocation. For example, Coca-Cola entered the movie industry back in the 80s, but their business was so big that this misallocation wasn't a big deal. Another example is how Amazon throws basically money at the wall to see what works, but since there are some outliers in this strategy, it makes up for all the rest. So the fourth reason to sell is if you find a far better investment opportunity. And I want to say it twice, a far better. Switch only if the new opportunity really is far better than the current holding. Because remember that when you have hold a given business for quite some time, you'll have a different understanding and familiarity with it. and that requires time. So if the new position you are considering is only possibly slightly better, it isn't worth switching. There are also other reasons for selling, such as tax loss harvesting, but those are more specific and not general rules or principles. So after you have read all the reports, it's very important to conduct your own valuation. So doing your own valuation before looking at the business price is crucial for making informed investment decisions. Valuation involves assessing the intrinsic value of a business based on its financial growth potential and industry outlook. By conducting your own valuation, you gain a deeper understanding of the company's worth, independent of the market price. This helps you avoid overpaying for a stock and allows you to identify undervalued opportunities with the potential for higher returns. Relying solely on the business price without understanding its true value may lead to investing in overpriced stocks or missing out on valuable investments. Valuation empowers you to make more rational and strategic choices. Aligning your investments with the company's real worth rather than short-term market fluctuations. And note the importance of not paying attention at the price of a stock or market cap before running through all this process, because as we have already suggested, this may create subconscious biases. Finally, you want to check the proxy statements. Check if the management has skin in the game. In simple terms, do they have a significant portion of their net worth tied in the company's stock? If yes, that's a positive sign. So, in this video, we discussed a comprehensive investment checklist to make informed decisions and identify promising opportunities. Remember, speed is essential in dismissing unsuitable companies during part 1 of the checklist. Once a company passes part 1, thoroughly analyze financial statements, annual reports, and management discussions. In part 2, look for red flags and know when to sell, considering competitive advantage, valuation, and capital misallocation. After conducting your analysis, avoid checking the stock price before doing your own valuation. Pay attention to management's incentives and explore competitors' reports for industry insights. By following this checklist, you can confidently invest and aim to maximize your investment success. I hope you found this video helpful and informative. If you enjoyed it, please don't forget to click the like button to let YouTube know that you enjoy this content and also to motivate me to keep doing this. Take 20. I hope you found this video helpful and informative. If you enjoyed it, please don't forget to click the like button to let YouTube know you enjoy this content. And also to motivate me to keep doing this because I'm having such a blast. And don't forget to leave any feedback on the topics we discussed because this is a mutual learning journey. So I also am very curious to learn with you guys and with your experiences. So I hope to see you around in the next videos and happy investing, everyone.